Hi, yeah, thank you, Matt. Really interesting. Hopefully we got Andrew on the line. Can you?
Yeah, I'm
Yeah,
on.
hi Andrew. How you doing?
Hi, good, thank you. Good.
Good. Really interesting time for real estate. So it'd be great to hear your views on the sector and obviously your company have been very busy recently. So maybe we do what we always do, give you sort of 5 or 10 minutes just to run through the company. We've got slides here and we'll take questions after that. So I'll pass over to you.
Great, thanks. Morning, yeah, still morning. Thanking you for having me on. Just a quick slide here on the backdrop. I mean, a lot of this data will be familiar to most of you listening this morning. At a macro level, we continue to live in a rather turbulent environment. The combination of various black swan events that seem to be taking place at a increasing frequency these days. We've got a huge amount of central bank intervention taking place across the various jurisdictions at the current time, as the central bank try to get the inflationary pressures under control. I mean, this affects obviously real estate, as you might expect. The biggest impact is actually the 5-year swap curve, because that's what most real estate debt is based off. And whilst there are an awful lot of equity investors in real estate, certainly the larger ticket items and the big investors in real estate are all using debt to try and turbo their returns. So elevated 5-year swap curves make that very, very difficult. And as a result, it has a massive impact on pricing and obviously liquidity. That said, I mean, the glass is always half full. I think there are a lot of positives out there. We think that inflation pressures are moderating. This week's print suggested that, and our views are that from the various research that we read is that we could be at 5%. Inflation could be down at 5-ish% by the end of the current year, and then hopefully traveling through to 4% and hopefully lower as we travel through 2024. Cost of living, there's a lot of chat in the press around cost of living crisis, the impact of higher mortgage rates. The good news is that energy costs have been coming off a bit through inflation has been moderating. And the fact of the matter is, we have a job full economy. People are in work with record low unemployment. We've got relatively full wage growth, which is helping to avert any cost of living crisis. The mortgage bit works. The mortgage costs are obviously going to impact as people come off fixed rate mortgages. I think it's around about 800,000 people a year are going to come off fixed rate mortgages. But you've also got 500,000 people who are repaying their mortgages every single year. So we've got that we've got a turbulent macro environment. And then what we've got going in our, is structural change, structural evolution accelerated through, technological advancements, which having an impact on how we work, live, socialize, and obviously that it has an impact on various real estate sectors, which are winning and which are losing, and which are probably coming, which are coming under pressure. I'll come on to talk about that in a bit more detail later. And then together with continual urbanization, the lack of residential accommodation almost across the United Kingdom is seeing an awful lot of commercial buildings being replaced by, certainly those obsolete ones being replaced by residential. And increasingly in real estate today is this sustainability and making sure that we are improving the energy efficiency of our buildings, and that has got massive implications, particularly for some of the sectors. Offices spring to mind, shopping malls, etc. And that's going to affect liquidity and pricing over the next number of years. So on the next slide, you take all that in, and not surprisingly, we're seeing a bifurcation of performances and a polarization of sector performances across the traditional real estate sectors. We find it very difficult to look outside, sheds, beds, and breads. To be frank, as winning sectors that are delivering not only income but income growth, and it's that growth bit that I think is increasingly sought after, particularly with bond yields and borrowing costs so elevated. You need rental growth for real estate to really have a place in your investment portfolio. And that growth is missing in large parts of the office sector and also the retail sector. I'll come on to talk about the logistics, warehouse, industrial sector in a minute, because it is the backdrop of the backbone of our own portfolio. But you are also seeing good growth in student and PRS numbers that have come out from Granger and Unite in that space support that. And groceries, you know, I mean, the flippant comment is everybody's got to eat. But you know, the convenience grocery market is still in pretty rude health. What I would say is that I think that we've seen a number of new entrants over the last decade or so, you know, that extend now well beyond what was traditionally called the Big Four, and that now we have alternatives to the Big Four in terms of meeting our grocery needs, and whether or not that's online, obviously with people like Ocado, or whether or not it's convenience groceries with Aldi and Lidl, whether or not with Marks and Spencer's, Simply Food, Waitrose, Co-op, Food Warehouse, Stroke Iceland. You know, there are a number of new players now. That means that, you know, the days when our grocery demands were met by an hour and a half visit to your big Tesco or your big Sainsbury's, Asda, Morrison's is no longer the case. And as you can see there, I've shown just, you know, the NAREIT stats for 1 and 5 year shareholder returns across those various sectors. Looking at LondonMetric, we increasingly look at the structural shifts, and that helps frame how we allocate capital and the makeup of our own portfolio. You'll see in a moment how the portfolio has evolved over the last 10 years or so to focus on the logistics market. Quite frankly, looking at where our money will best get a return. You know, our objective is to allocate capital into sectors where, you know, the money will be looked after and over time it will grow. And in the meantime, we will deliver an income and a progressive dividend. And again, we'll come on to talk about that in a little bit more detail. I think we're in our 8th year of dividend progression, and obviously we hope that will continue for many more years. Obviously, the macro backdrop has changed an awful lot over the last 12 months. I think we're supposed to be coming up to the anniversary of the Trust's quasi-budget, but it was changing well before that actually anyway. The fact about the market, the heat was coming out of the real estate market, and as a result of that, we've for the last year we've actually undertaken a disciplined disposal of a number of our non-core assets to make sure that we reduce any, we have our loan to value covenants under control in the event of downward pressure on valuations. But more importantly is to make sure that, if there is refinancing, we actually have equity to be able to repay it. If we've got floating rate debt, we would look to reduce our exposure to that, because it's become extremely expensive. And then finally, the last bit was something I always, a lot of shareholders forget to ask me when I see them face to face is the alignment of interest. We are an internally managed business. We are not an external manager. The company do not get paid. We do not, the bigger we get, we do not get paid any more money. This is not the remuneration here is not about AUM. It's actually more around TSR. And the fact of the matter is, the management team, are large material shareholders in the business, and we enjoy dividend progression as much as the next person. I can assure you, it's an important day 4 times a year in the Jones household. Just looking at the portfolio, I touched on the evolution over the last 10 years of our portfolio, and as you can see there on the right pie charts, the navy colouring shows our exposure to the distribution market. So it's just under 3/4 of our portfolio today, across urban, regional, and mega warehouses. And then we have the remainder is effectively made up of our long income grocery investments, let to the likes of Aldi, Lidl, Costco, M&S, Waitrose, etc., as well as some of the other brands that you see down there. That evolution has obviously involved a huge amount of liquidity in the property market. But we have an ownership culture. We want to invest in the best buildings. We want to, we'll pay a fair price for them. But making sure that we have, long leases, we have full occupancy, and that we have income growth. Whether or not that is through open market negotiations or whether or not it's through indexation. I'm not that bothered really. I just want growth, and that growth in our sectors is coming through without us having to buy it or invest heavily in our buildings like you're having to do, I think, across some of the shopping centre and the office sectors. And that's important to us. We try and operate to the best of our ability on what we call a triple net model that strips out real estate costs and their recoverables, because it means that after paying our interest costs and our staff, all of our rent flows through as efficiently as possible through to our shareholders via the quarterly dividends. Then just, I think Richard suggested that we've been busy recently. We closed earlier in the summer on an all-share acquisition of CT Property Trust, which was close on a £200 million offer, 100% share-based offer. And the attraction for us of this is a company that's trading at a big discount to its NTA. But it gave us access to the two areas of the real estate market that we cover the most: urban logistics and long income retail and convenience. And that was the driving the opportunity for us. The non-core retail and offices will be disposed of over the coming months. We thought that there was strategic rationale actually for both sets of shareholders, more efficient management structure, because we go from an external manager to an internal. That obviously saved management fees. We actually haven't taken on any additional employees. The 34 assets have been absorbed into the existing platform that we have here at LondonMetric. It was marginally NAV accretive, it was EPS accretive, it was LTV accretive, and we were buying it off a net initial yield that was slightly higher than what the existing LondonMetric yield was delivering. So arguably it was income accretive as well as that. And the economies of scale are such that we will deliver. It does deliver greater income granularity, and as I said, and we've taken a lot of costs out, which will allow us to progress earnings over the current year, or help us progress earnings over the current year. And we think we have a more intensive management approach as internal owners of the business, as opposed to rather than external managers might have. And the fact of the matter is, it's all gone relatively well so far. We've started to make our first divestments. We've sold some high street retail properties, and we will announce some further disposals shortly. So, I've already touched around real estate, not only delivering a coupon, but also delivering growth as well, and that's quite important to us. And that comes essentially through rent reviews and lettings for us. And that's why we allocate our capital into the winning sectors. For us, that is at the moment sheds and breads. We've been seeing some good income growth. And I think this is outside of maybe the PRS and maybe the student sector. I think we're probably delivering superior rental growth. These sectors are delivering better rental growth than anything else in the UK property market today. And we will continue to capture these reversions as they come up over the coming periods. We have at least 11 million of embedded reversion to collect over the next couple of years. And again, that's all part of this, delivering this progressive dividend policy for us. And that will see us. You will see us actually look at, coming out of, maybe taking some money off the table in some of the sectors and reallocating it into those that are going to, where the money will be treated best. Lettings, we have very low vacancy rate, as I touched on before. So actually, open market lettings are more, less relevant for us, except asset management initiatives where we look to capture reversions through, taking back a surrender of a build. I mean, we took back, you see a picture there of a warehouse in Uckfield that was previously let to John Lewis. We agreed to take a surrender of that from John Lewis. They paid us some money for doing it. We relet it immediately at a higher rent to another business, and that helps us with that earnings and or rental progression. And then on the environmental bit, we're very, very plugged into this. You can see there that 90% of our assets are classified as EPC A to C. That's a material uplift from where we were a few years ago, and we've obviously still got further work to do on that. But we are constantly looking at new initiative, installing new solar PVs, in partnership with our occupiers, to try and improve the energy efficiency of our buildings. And, and that also now extends to EV charging, which is going in all the time. We have partnership, particularly with Instavolt, but also with MFG to put in EV chargers across our portfolio. I think we would have added at least £100,000 worth of income from EV chargers over the last 9 months or so, and that's important. Not just for income generation, but actually for attracting, different, more customers to our locations, and improving the energy efficiency of our tenants. So that's something that we're, again, excuse the pun, but we're pretty much plugged into, and it's something that is high on our agenda. So look, the outlook, and I've probably gone past 5 minutes, I'm afraid, Richard, but it remains to be challenging. Fundamentals, I think, in the preferred real estate sectors remain strong. And I think that market uncertainty will actually, will continue to create opportunities, particularly as debt refinancing becomes challenging for some people, and some investors. So I won't go any further than that. And I'm sorry, we can cover some of those topics in some Q&As.
Yeah, sure. Yeah, we've had quite a few come through already. Maybe if we start with the big acquisition recently of CT.
Yep.
I'll go back to the slide actually, so we can have a look. There we go. So obviously, there's a lot of synergies there with your current makeup of their portfolio and your portfolio.
Yep.
There's also some non-core there. How much sort of non-core do you think you will need to get rid of, and how long will that take, do you think?
Well, it's really the office and the retail that you see there in the pie chart, which is roughly 22%. We went into this knowing that it was non-core. We went into it putting an appropriate price against each individual asset, and the price we put was what we call the clearing price rather than the valuation price, because there can be some discrepancies between those two numbers. As I said, we've already sold to the high street retail. We announced that last week. We've got a little bit more of that to go, not too much. And then offices, there are numerous offices scattered around the UK. Some are going to find more appeal than others. We've probably agreed terms to sell 3 of them at the moment. So we're pretty motivated, and I think we've priced them to sell. Those are sectors that we don't really want to spend too much time in. We think that the challenges facing regional offices of an age are pretty tough, both from an occupier perspective, but also from an ESG EPC perspective. And this, in some ways, that's not what we're about. That's not to say that the buyers of these can't do quite well, but it takes a different type of discipline and a different approach. And our time is better off spent in sectors where we do have, some level of competence and some dominance. Yeah,
no, that's cool. And there's been a lot of M&A activity recently in the REITs and property sector. Do you see that happening and going forward more? Yeah,
look, I think certainly the real estate, the investment trusts in the real estate sector, there's a lot of them. A lot of them are subscale. Their capital structures are suboptimal. They trade at they don't trade much at all, to be frank. But the prices on the screen, are at 40, 30, 40, 45, 50% discounts to their supposed NAVs or NTAs. And actually, they seem to be serving more of a purpose for the board and for the manager than they do for the shareholders. And I think that the reason you've seen a tick up in M&A in that sector is for exactly that. At the end of the day, these companies are owned by the shareholder and not the manager, and therefore, there is a duty on behalf that the board has in order to deal with that. And if those discounts are going to persist, and they have persisted now for closer on a decade, or certainly somewhere between 7 and 10 years, it's beholden upon boards to look at look at doing something about that, whether or not it is a sale to somebody else, whether or not it is a merger, or whether or not it is a liquidation. I think that this can't be allowed to continue, because at the moment it seems to be that shareholders seem to be losing out, whilst managers and boards, take their fees.
Yeah, I agree with that. Okay, if we move on about your sales recently, there is a slide on here. You made 280 million of sales.
In the last 12
months. Got a question here on that. Could you elaborate a bit more on your philosophy around pruning the portfolio? It seems like you're active recycling capital. Do you want to talk about what you're selling, why you're selling it, and what you're looking to sort of redeploy that into?
Yeah, it's a good question. I mean, the large majority of that would have been our decision about a year ago to exit multi-let industrial estates. These are your traditional industrial estates, small units, big concentration around Birmingham, aging buildings, which were going to require quite a lot of capex, and also they're operationally, they are management intensive. And we made a decision, I'd say about a year ago, that actually that wasn't our core competency, and that actually increasing capex requirements, and if there was going to be a downturn in the economy, maybe some of those customers of ours or tenants of ours were going to feel a little bit exposed. And so we set about doing that in various transactions. And it was a market. It's a sector that's been well received. The final piece of that jigsaw, so to speak, was executed about a week or so ago, which was four multi-let estates that we sold to an American investor for just over 40 million. So, and we're pleased with that. We like, there was always leakage in the income. There was always costs of effectively keeping the doors open and the buildings wind and watertight. So we're pleased with that. Within that 280, there will be a little bit of high street retailers, so that we acquired through CTPT. We've also sold a number of some of our more mature grocery investments. We've been selling some Aldi's, Lidl's. We sold a Waitrose recently down in Malmesbury that we sold to private family, off a yield that was well below our cost of capital. We sold it for just over 4.6%, because somebody else had a lower cost of capital than we did. So that will be monetized, and then the capital is reinvested into other opportunities. We're working with, for example, we're just on site. We're funding a new Marks and Spencers down in Uckfield. We're talking about building another Simply Food facility for them as well, down in Weymouth. And so we'll recycle it where we get basically a higher return on that than the 4.6 that we've just received. And so we don't start any year off with a sales target. We have a desire to sell certain assets that we think have reached maturity. Where we've may have just done an excellent rent review that exceeded our expectations. We might take the view that going forward, the returns, the growth returns going forward might be a little bit more muted, because we've taken some lofty returns up front. So we do that, and also we react to approaches that we get from people interested in and who covet some of our buildings at prices maybe that exceed our own view. And so we're not emotionally attached to any building. Every building has a number which we will trade it at.
Yeah, nice. That's good. Thanks. Where should we go next? So your long income portfolio. Why is long income attractive to you? What are the sort of pros and cons, and what do you look out for in the long income?
So the long income is completely triple net. Okay, so there's no service charge, shortfalls. It's 100% let. I think 75%, actually might be a bit higher than that now, of the rents are linked to inflation. It is what we call internally is low energy. It is those people that you see there. It could be a BP, it could be a Range, a Pets, a Dewsons, a Wicks. And these are largely in sectors that we think are pretty protected, from consumer, changing consumer behavior. Grocery, convenience grocery, we think is a winner. We think that the DIY market looks pretty solid, and that's trade and DIY. You see it there: Juicens, Pet, Wix, B&Q, and then we have MKM as well. Actually, would fall into that. And so it's very much at a yield that sits way above our cost of capital, with inflation growth on top of that. Let's remember, whilst we have elevated bond yields today, the government indexed yield is trading at around about 1.3%. So if you can buy let's say an Aldi or a Lidl for 5.5 with RPIs. Albeit capped, say at 3.5 or 4, that is, that's nearly 400 basis points above what you pay for an index government bond. And I'm not convinced that the Aldi or Lidl covenants are that much weaker.
Yeah.
Sorry, they obviously are weaker than the government, but I'm not sure they're 400 basis points weaker.
Yeah.
But similarly, again, we it's a market that we come in at. We'd be happy to sell out at mid-4s to reinvest at mid-6s. Under a funding or development or even an asset management initiative with the occupiers.
Yeah, cool. Okay, you mentioned there about the caps on some of the inflation linked. So we've got a question here on what percentage of the portfolio has capped income uplift, and what are they?
Well, all rents, you see there, 63% of our rent roll is indexed, but all of it will be capped. And the caps normally bite at somewhere between 3 and 5% per annum compounded. So for example, so what that means is that you don't capture periods of elevated inflation that we've had over the last 12 months or so, but they also have a collar or floor that normally kicks in at somewhere between 1 and 2%. So in periods of very low inflation, you're guaranteed some element of growth that might not be available in the index market. What I would share with you is so, for example, I was looking at the data recently. Over the last 6 months, we've settled a number of rent reviews, and our RPI CPI rent review settlements that on a 5-yearly basis have come in at about 24% up. So whilst we haven't been necessarily collecting the highs of inflation over the last 12 months or so, we have still managed to capture close on 5% per annum over the last 5 years, which I think is I think that's a very, very credible return. And also, one of the things about uncapped RPI is the big danger you'd have, and I've no doubt that if I said to you all of my indexed leases were uncapped, as a real estate expert, Richard, you'd be saying to me, well, does that not worry you that some of your assets are now going to become over rented? Yeah. So we would rather, we're pretty happy with the profile of the RPI piece, actually. But they're all secure. It's 100% let, and they are secured by and large. There's always going to be an exception in there. I'll pick out Odeon for you just in case, just before somebody else does. But by and large, I think the credits there are pretty good for us. And the desirability of our real estate is as I suppose, is illustrated by it's best illustrated the fact that it's 100% let.
Yeah, exactly. Cool. Okay, moving on now. I think we've got a question here on your solar, and you obviously mentioned that in your sort of presentation just there. Who benefits from the investment and the revenues? Does that go straight to you, or do you?
It varies. It absolutely varies, which depending on the deal. What we've often done is, if it depends on who's paying for it. Obviously, if we're paying for it, we expect there to be a return. What we tend to do is put, my ideal scenario is that we pay for the installation, and then we effectively lease it back to the tenant, so that at a number that allows them to benefit from a saving. But also gives us a relatively, not an attractive return on our capital. I mean, it's not excessive, but it's an attractive return on our capital. And then they're responsible then for its ongoing maintenance. so that if it drops off for whatever reason, they don't, there's no claims coming against me. So that's our ideal scenario. And that also allows us to structure it such that if we were to sell that building, the additional rent will then get capitalized out at probably the same capitalization rate as a buyer would apply to the core rent on the underlying building. That would be our perfect scenario. But everyone's got a slightly different view and a slightly different preference, and it's not like one size has to fit all. We're pretty flexible about that sort of thing.
Yeah, and are tenants sort of receptive of it?
Well, yeah. I mean, look, you can't do it without them. Would we like to see more? Yes. Are we seeing an uptick in it? Yes. I mean, there's nothing like a spike in energy prices to get people to open their eyes and and start looking at these various initiatives. We're working with some big players. We've worked with Currys, we work with Primark, we work with Eddie Stobart. We're working with some serious players, and we're also working on some of the smaller buildings as well. So look, we really like it. We think this has got a long way to go. This has got a long way to go. And let's be honest, we didn't start off as being experts in this field, but we're learning very, very quickly. And the same goes with our EV, our EV relationships. We're understanding that, and how the owner of an electric vehicle behaves differently to the owner of a combustion engine. It's very different.
Interesting. Yeah. So while we're on it, on sort of energy and the energy efficiency of the portfolio, so you've done a lot of work to bring the EPCs up to an A to C. What is your view on, so what sort of capex would that entail, and do you make any money off of that investment in sort of rents and things?
Yeah, the one thing about, I should just point out with our buildings is warehouses are relatively simple constructions. I mean, I'm probably not going to say that when I'm letting a big building, but anyway, they're relatively simple. Retail warehousing is relatively simple. An Aldi is a relatively simple building. Okay, it's not like offices or shopping malls or even hotels and things like that. So we start with a pretty simple, sheet of paper. The costs involved, therefore, are not, they're not dramatic. What we've been finding is that the money we spend on the building is more than returned from the tenant, existing or new, being prepared to pay a little bit more for a more efficient building. And let's be clear, whilst A to C 90 is good, we really would like that 90 to be A to B. Yeah. It's got to get better. Now, it doesn't always go in a straight line, despite all our efforts to improve the efficiencies. There are times where we see an opportunity to buy a poor building. We see an opportunity to buy a building that might be rated a D or unrated, because we think that we have the desire, the expertise, and the capital to bring that building back, into economic use and economic relevance. And so there's no doubt going to be periods where our energy efficiency might drop below 90. That doesn't mean that we're not doing the job. It just means that we're helping poorer buildings get better. In the view of the matter is, I think we are great stewards of bad buildings, because we like I said, we have the capital, the desire, and the expertise. There are an awful lot of landlords out there who don't have that. They have no interest in improving. And the fact of the matter is that whilst my EPC, by not buying that building, all right, it might help my ratings, but it's not helping the planet.
Yeah. So does that?
So we shouldn't be castigated for sometimes if that drops, because we're doing the right. We like it. I mean, I'll be honest with you, at a personal level, one of the greatest satisfactions I have in my job is when we buy a poor building, we spend money on it, we bring it back, we re-let it, and then we sell it. And that's one of the highlights of my job. I mean, I really, really enjoy doing that. I've been doing it in shopping malls and retail parks and now logistics, for a very long time.
So I suppose there's a lot of opportunities out there at the moment then for poorly rated buildings. I mean, are they being heavily discounted because of their poor energy efficiency?
Yeah, they're not. The truth of the matter is they're not being discounted because of energy efficiency. They're probably going to be discounted because the vendor's capital structure is all wrong, and he's got debt problems and leverage issues and hedging and expiries or whatever else. So, the truth of the matter is it will come into price without a doubt, because we're going to have to set people. Buyers are going to start setting money aside for bringing them back. I think the first wave of opportunities today, and I said it, in my closing slide, market uncertainty will create opportunities, for the longer term investors. But most of that's the first wave of those is definitely coming from a debt backed position rather than an EPC at the moment.
Okay. Right, we're rapidly running out of time, and we've still got a few questions left. So,
okay, cool.
Where should we go first? So, a couple on the demand side. Have you seen a drop off for the demand for logistics given economic uncertainty? And then also on that subject, online retailing seems to be plateauing. What implication will this have on demand and take up going forward?
Yeah, so I think demand for the bigger boxes, 150, 200,000 square feet plus. I think the demand is moderating post the massive spike we saw during COVID, and also you are seeing supply coming into the system that will basically deliver a closer equilibrium between demand and supply. So we think that's going to happen. However, I think that when you get through 24 into 25, on the basis that there's no development being undertaken, there are no new starts being committed today, because of the cost of materials, but also the cost of finance. I think there is a danger that you end up then, as you travel through 25, 26, with a shortage of new modern warehousing. So I think demand is okay. But there has been a tick up in supply, which means that rental growth will probably moderate over the course of the next year rather than the current year. Doesn't really affect us because we don't have any speculative developments going on site at the moment, and our rent reviews will still capture incredible periods of rental growth over the preceding 4 or 5 years. So I don't think the demand drop off is anything to do with the economy necessarily, but it was more the fact that it's coming off a COVID spike, where we saw what I call emergency demand for warehousing from a number of operators. As far as online penetration is concerned, it's still growing according to its long-term trajectory, albeit it's off the highs during a lockdown, as you might expect. But we're moving from pre-COVID. I think total penetration would have been around about 20%, and we're heading, we're going to be head up to 30% on an overall basis. GM will be much higher than food. I think food pre-COVID was 7, it peaked at 15, and it's probably hovering back around about 10. So we're still seeing ongoing online penetration, because the modern consumers are, you look at the generation, my children's generation, they're much more likely to buy online than maybe I am. Although I was going to say my wife and I, but she seems to be pretty prolific. And therefore that will continue to grow. But what we're not seeing is the massive growth that we obviously saw in lockdown, when we were probably up at 50%. For our own portfolio, we've increasingly pivoted into urban warehousing, so sub 100,000 square foot space around major cities, London, Birmingham in particular, where the range of occupiers that we deal with is just vast. I mean, it's just vast. I mean, if I look at some of the lettings that we've done this year, we've done coffee roasting facilities. We've done we've let a warehouse, to Screwfix. We've let another warehouse to McDonald's. We've let another warehouse to, a business that ships fine art across Europe. We've let a warehouse to an accident repair center that deals with bangs and scratches on your car. So the sort of we frozen fish wholesaler, the sort of people we deal with, if we do get a vacancy, we just have no idea what sector that occupier will come from. It's vast, and so you know, we prefer that to being beholden to, you know, a bigger box whereby we either have to really try and let it to an online retailer or an omni-channel retailer to satisfy the growth in their business, or we have to let it to a 3PL, you know, a DHL or a FedEx or an XPO or GXO or whatever else. And so we just got a much wider span, you know, a circle of depth of businesses.
Yeah, cool. How much of the portfolio is in development? Do you have any developments?
No.
Okay, cool. That's nice, quick one. And then obviously the question of the day is valuation. Now, there's a massive valuation drop at the end of 2022 across real estate, but especially in logistics, about 20%, I think. Do you think that's it seems like value is a bit more proactive this time in revaluing that can only be a good thing, but it's obviously not been reflected in share price discounts to NAVs.
No, look, I mean, I think you're absolutely spot on there, Richard. I think the values actually did react very quickly. I think they certainly have done a much better job than they did when we came out of the GFC, that's for sure. You know, logistics yields, the valuations feel as if they reflect where the market is trading. So I wouldn't expect the logistics market to move too much between March and September, unlike, for example, the office market, you know, where you're probably going to see some big drops, you know, ongoing drops, because actually, as you rightly said, I think logistics actually not only took it hardest but took it first. You know, I remember looking at the numbers. I mean, some of the shopping centre valuations hardly moved. I mean, or some of the office valuations hardly moved, and I couldn't understand it. So, but you know, the relationship between NAV, NTAs, whatever you want to call it, and share prices, you know, it ebbs and flows. There are times when you trade at premium, trade at discount. The fact of the matter is, you know, I think income and income growth is an equally important measure. I mean, you know, we are the only jurisdiction in the world that seems to be obsessed with NAVs. You know, I was talking, you know, you look at the American model and it's all about free cash flow and growth, you know, and you ask the chief exec of some of the American REITs, you know, what's your NAV? He said, I don't know. I don't. Why would we calculate that?
Yeah, no, it's interesting.
I think, look, I think as you said earlier, you know, we're in the market. We're relatively active. You know, if you think about the 280 that we've traded in the last 12 months, I mean, that's not far off 10% of our portfolio. It's must be about 8% of our portfolio, and we would have done that at, give or take, either +1 -1% of our NTA. We think our valuations are pretty accurate. And in my view, it goes back to the small cap in real estate investment trusts that we look at, including the CTPT business. You look at Epic as well, Ediston. You know, if you're not happy with it, do something about it. Either, you know, sell yourself, or liquidate, because otherwise the only people I say that you're serving is the manager and the non-execs. I mean, you'd be amazed at how reluctant some chair people are to meet me. You'd be amazed. You would be amazed. I wouldn't mind if they were trading it now, but when they're trading at 45% discount, you would have thought they might just want to take a coffee.
Yeah, okay. Well, that leads us into what shall be, I think, our last question. So, in your view, what would you recommend retail investors to focus on when analysing different REITs? What are the key metrics? That's a brilliant question. That's a brilliant question. That's a really, really, really smart question. Look, I think we've got to, you know, accept that technology is impacting our lives, and that in turn is going to impact our desire for certain types of real estate and how important they are. So, you know, I would start with let's look at the sectors. You know, I think it's a brave person to go into offices and shopping malls today. So for me, it is, you know, it would be look at the beds, sheds, and breads market. The second thing I would look at is it internal or external? You know, without a doubt, you get better behavior with internal. Without a doubt, there's alignment of interest
The problem in external, there's always an incentive to try and grow or artificially inflate your NAV in order to maximize your management fees. Okay. So look at internal v external. Do you really need to take the risk of external? You know, I'm not going to mention the name because you probably know it, but you know, we have had a few blow-ups in the housing sector where people have been spending other people's money as opposed to investing their own. Okay. Thirdly, look at management alignment. How many shares, what sort of monetary alignment does the management of the company have in the company? You know, how many, you know, what's their ownership like? You know, there's some wonderful companies out there where the chairman, the chief exec, the board, the director, they have big meaningful holdings that mean that they've got to do a good job. Otherwise, you know, their family's position is at risk. And then look at earnings. I mean, it amazes me about, you know, looking at earnings, look at what's driving the earnings and also the dividend. I mean, I can easily, you know, so many people, you talk about, oh, well, we pushed the dividend up, it's now yielding us 8%. Well, it's not really, because it's uncovered. I mean, what it means is it's yielding you an income dividend maybe of 6, and actually they're repaying you 2% out of your capital, because uncovered dividends, you know, they're paid for out of capital. You know, they're not paid for out, they don't come out of thin air. So you know, look at the sectors you want to be in, look at the management structure, look at the management alignment, and then start looking at the earnings and both its trajectory and then its relationship with the dividend. And then the NAV can follow after that, to be honest with you, because but it would be in that order, I think.
Yeah, brilliant. Good thorough answer. I like that. Cool. Okay. Yeah, I think we're at the end, and I've found that very interesting. I hope everyone viewing has too. So thanks a lot, Andrew, and hopefully we'll get you on maybe in a year or so's time to get an update. But
all right, I'd be very welcome.
Well, thanks a lot.
Delighted. Cool. All right, have a great weekend. Thank you ever so much for committing the last 45 minutes listening to me. Thank you.
Thanks a lot for joining. Cheers.
Take care.
Bye. Right, that just leaves me just to show you the roster of our guests coming up, as you can see there, and hopefully we'll see you all next week. Thanks a lot.